Good afternoon. Thank you to all of you for joining us. My name is Pam Mazza, and I'm the managing partner at Polero Mazza, law firm in Washington, D.C., and I'm joined today by John Shiraka, who is the managing director of our new Polero Mazza Advisory Services Group. Today, John and I are going to talk to you a bit about the evolution of the 8A program and a little bit of what lies ahead as well as where we are currently. So in order for us to be as relevant as possible, we've got a little poll on your screen, and if you could fill it out for us. We're interested in knowing how many of you are currently in the program, how many 8A graduates we have, how many people who are not in the program but interested in applying, and then how many tribal entities we have. I see you're all working busily to fill it out. Thank you so much. And the slides will be on the screen. You can also download them from the website. Okay, I think we have enough of the poll to get started, but please continue to fill in your answers if you haven't done that yet.
Okay, so this is John Shiraka. I'm happy to join you guys today. Thank you for taking the time to be with us this afternoon. The slides are actually pretty extensive today, but what I'd like to try to do is talk about the various sections that are on here, and then hopefully leave some time for Q&A. Leave some time for, oh, there we go. Bear with us because we have multiple screens and lots of windows on this end that we're trying to figure out, but I think we're there. So we'd like to cover these topics today. Bear with us for a moment. I think there's a lot of good things we can go through. There's a lot of history in the 8A program that we can talk about, the evolution of the 8A program, sort of what I think Pam refers to as the lookouts with respect to initial certification and program compliance, and then where we're headed with respect to the program and some of the changes that are potentially going to have an impact on the 8A program, as well as what potentially we can expect under a Trump administration. So having said that, we can skip onto the timeline of the 8A program and talk a little bit about the creation of the program, the intent of the program, and so forth. Does that make sense?
Sure, sure. So in 1953, Congress enacted the Small Business Act, and then 15 years or so later, the Congress amended the Small Business Act to add Section 8A, and it is actually Section 8A of the Act, and that created the 8A program. When the program was initially created, it was created for disadvantaged businesses who were owned by socially and economically disadvantaged individuals. So the program at the outset was for individually owned 8A companies. Then in 1982, Congress amended to recognize federally recognized Indian tribes as a part of the 8A program. In 1988, Congress added Alaska Native corporations, and in 2002, Native Hawaiian organizations were granted 8A status.
So I think we'll talk about the differences in the programs, et cetera, but generally speaking, obviously I think we see a lot of the folks in the survey, and it shows about 48% are currently 8A companies and 23% graduated, 30% interested in applying to the program, and 27% are tribal entities. Obviously, there are differences in the programs with respect to the type of entity it is, individually owned, tribally owned, ANC, or an HO owned. And we can certainly get into some of those as we get into the details. But originally, in the early days of the program, the competitive landscape for the firms was much, very different, right? So the smaller firms, individual firms, had no limits with respect to sole source, right? There was no business mix restrictions. Firms could be sold, and the sale of contracts could occur, etc. A lot of that was amended over the years, and basically I think the concept or the changes, or at least the policy initiative behind those changes, was the concern that the benefits flow to the intended recipients, right? So over time, as the program evolved, I think there were either changes in the regulations or statutory changes that not only made sure that the benefits flow to the intended recipients, but then also created these other types of ownerships to make sure that certain communities could benefit with respect to the 8A program. And again, the intent is economic development in the tribal community, in the Alaskan community, and the Hawaiian communities. So there's sort of two different programs, I would say. I don't know if you agree with that, Pam, but they are kind of distinctly different. One is to benefit a community, and the SBA looks to see what kind of benefits are flowing to those intended recipients, and the other is making sure that the individual owner who is economically disadvantaged can benefit from the program.
That's right. I agree with that. And I think that the history is interesting because if you look back in the early days, there were no restrictions on sole source contracts. There did not need to be competition in the 8A program. And I always thought when we had the biggest changes to the program occurred in the 80s. And that again was when there were sole source awards of unrestricted size for all 8A companies. And so I think that helped to bring about some of the other changes, like they didn't want large businesses to buy these 8A companies that had 100% sole source 8A contracts. They didn't feel that that was the intended recipient, as you said, John, and they didn't want to, they wanted the firms to be healthy, so they put the business mix restrictions in, and they put the 9-year time limitation on.
Yeah. And I think this chart is a good indication of the market as it related to 8As competing for set-asides in the early days, right? I think this articulates the fact that there was an overall 20% goal and the 5% 8A or small disadvantaged business goal. You just talked about the fact that there were no limits, et cetera. So it really was an environment where the firm could take advantage of the program to significantly benefit from the program. And that environment has to a certain degree changed, although at the SBA, we saw performance in SDB/8A somewhere in the 10% range over the last several years. But certainly the environment has changed, whereas there are significantly more set-aside programs, there is significantly more competition, and there's significantly more restrictions with respect to sole source, et cetera, right?
That's right. So if you look at this slide, you can see that the 20% goal has advanced to 23% for any small businesses. And then we have the subsets, 5% for 8A, 5% for service-disabled veterans, and then 3% for HUBZone companies and 5% for women-owned small businesses. So you have increased competition for set-aside dollars, and recently a regulation that tells the contracting agencies that that there should be parity among all of these programs, so that if a contracting officer sees that it needs to increase its HUBZone awards, it can set something aside, HUBZone versus some other program, without worrying about that, and they're encouraging parity, except for the little caveat that once a contract is put into the 8A program, generally SBA likes that contract to stay in the 8A program if it's a repeat buy.
Yeah, and I think with respect to parity, Pam mentions the changes in the regs. I think it was the Small Business Jobs Act of 2010 that reaffirmed parity. And obviously, I think, you know, it is at the discretion of the contracting officer or the buying activity or the agency, depending on what goals they're trying to meet. I think at the end of the day, there are several things for small businesses in the marketplace to sort of understand and take advantage of. One is, for a contracting officer at the end of the year, 8A sole sources are easy to do and quick, right? Mm-hmm. Another is that if you have multiple designations, you're oftentimes more attractive to a buying activity or a contracting officer. Because the agency, and a lot of folks, you know, when I was at the SBA, a lot of folks didn't understand or were surprised when they found out that an agency can get multiple credit, right? So if you are WOSB 8A, HUBZone, STVOSB, sort of like the unicorn, that agency is going to get quadruple credit for that purchase. So they meet all those, or it goes towards all those goals. So one of the things that you may want to consider is if you think you're eligible for any of the other programs, you should definitely pursue that because it makes it more attractive to the buying activity for them to engage with you.
We should have put unicorn on our poll.
Yeah, how many unicorns do we have?
Also, if you have questions, I don't think we said, but please type them in, and we'll try to answer as many of them as we can before the program is over, but if not, we will get our answers to you by email.
Yeah, go ahead.
Go ahead.
So I think just in general, when we talk about the 8A program and when the SBA and the agency think about the 8A program, one of the distinguishing factors is that it is a business development program, right? So there is a 9-year business development and this has evolved over the years. So there's a 9-year process. The intent is to grow during that process. You have the opportunity as one of the tools to engage in sole source contracts, but there's also the presumption that you will sort of be weaned off of those sole source contracts during your transition years in years 7, 8, and 9. So different from, for example, HUBZone or WOSB or even STVOSB, where the focus is on contract opportunities and set-asides for those socio categories.
That's right. And one thing that is different with the 8A program from the others is that there are sole source contracts available under the competitive threshold. And for individuals, it's $6.5 million for manufacturing contracts and $4 million for all other contracts. That's current. These are adjusted for inflation every so often. And then again, for the tribal entities, there's not a restriction on the sole source, except that under the Defense Authorization Act, agencies have to do a justification for sole source contracts to any entity, not just tribal entities, but over $20 million.
Yeah, and that's one of the questions that come up as I was looking through the questions. There is no sole source ceiling if you're an ANC entity, or for that matter, tribal entity as well. Mm-hmm. But there is the justification and approval.
That's required.
That's required as a result. I think it was the Small Business Jobs Act of 2010. It was somewhere.
It was the Defense Authorization Act, because that applies not just to smalls but to all.
Everybody.
Okay.
But the question is there a ceiling for ANC sole source? And it did go up, by the way, to $22 million because of inflation. I think it recently went up. But there is no ceiling. There's just the fact that over $20 million, you have to have a J&A. The other thing to just clarify is that there's no ceiling for NHOs either but only with the Department of Defense. The sole source, unlimited sole source for NHOs is limited to the Department of Defense.
Okay, and comparing that to the other programs, each of the other programs has the ability to sole source, but it's not the same as the 8A program, because in the 8A program, self-market, a procuring agency wants you, you can have that sole source, but in the other programs, the agency has to establish through a J&A that there is no other SDVOSB or there is no other WOSB that can do it. So this is an advantage, again, for the 8A firms, is that sole source ability below the threshold.
Yeah. And we can talk through the criteria. I don't know if we want to go through each of these slides individually because we have limited time and I think we want to get to these Q&As. We can talk through the criteria sort of generally, and then if there are questions, we can go through those. I think the main sort of criteria for eligibility in the 8A program is that you have to be small, obviously, for your primary NAICS code, right? There are, and we can talk about the differences in the tribal, native, and NHO concerns, but you have to be small, you have to be economically disadvantaged, and you have to be socially disadvantaged. There are some, what's the term that they use?
Designated
groups. Thank you, Pam. There are some designated groups that are automatically considered socially disadvantaged, and those are Black, African American, Hispanic American, Native American, Asian Pacific Americans, and subcontinent Asian Americans. And then obviously, if you are a tribally owned entity, ANCs, NHOs, and what a lot of folks don't know is that CDCs, Community Development Centers, can also qualify to own multiple 8As, although in my time at the SBA, I think I only saw one CDC own an 8A. So it's a unique and not often used tool for CDCs. With respect to, because we used to get this question a lot, and I think there's more knowledge about presumption and being presumed to be disadvantaged and applying for the program. So as an example, we had Caucasian, white, females in the construction industry who could document that they had been discriminated against, and not only discriminated against, that's difficult to say, but it had had an impact on them with respect to either their income, their ability to get an education, the ability to support their families. If that argument can be made, then you can be found to be socially disadvantaged even though you don't fall within one of the presumed groups.
The standard of proof is higher than the presumption that you're disadvantaged, and you need to put together a statement of social disadvantage that shows that you've been discriminated against in education, in employment, or in running your business. You don't have to check all of those boxes, but you have to be able to establish that this was not one isolated incident and that it affected you. And the SBA recently changed their regulations to say that you have to be able to show that it's more likely than not that that bad behavior was due to a discriminatory reason and not some other reason. So if there are two people with the same alleged resume and the guy gets the job or the guy gets more pay, you have to be able to tell SBA that you were qualified as well, and that there was a discriminatory reason for the fact that you didn't get that promotion and the other individual did. So that was a clarification that the SBA recently made. I do want to spend a couple of minutes on economic disadvantage because I think we all, if we're in the program or thinking of applying or a graduate, we all are aware of the personal net worth requirements, but there are some other measures that are very clear now under the regulations that 8A companies have to meet. And there are two thresholds. There's a threshold for entry into the program and then for ongoing eligibility. So in order to get into the program, you have to have a net worth of less than $250,000, and you need to, but you can exclude your personal residence and any equity that you have in your business. There are also rules in terms of how you deal with your spouse, and it's generally if you have accounts with your spouse, they're split down the middle unless you've made transfers back and forth. So 250 entry level personal net worth, you must have an average annual income over the past 3 years of less than $250,000, and then you cannot have total assets, which includes now then the house, the equity in your company, and that can't exceed $4 million. The only exclusion for that economic disadvantage with respect to total fair market value is a 401k plan that's a qualified IRA. And I have here on this slide that as you progress in the program, that total fair market value of all assets goes up to $6 million. Firms that are owned by tribal entities have different rules for economic disadvantage. The tribes need to qualify for their first 8A, but that's based upon the economics on the reservation of the surrounding communities, the average income or the average salaries of the tribal members, etc. So it's a different level of proof, and it's somewhat burdensome to get all of that information together. But normally when you qualify for your first 8A, the SBA does not then come back and ask you again and again to prove the economic disadvantage of the tribe. Alaskan Native corporations have a different rule because their act, which is the Alaska Native Claims Settlement Act, sets up a presumption of economic disadvantage.
Yeah, and I'd just add that the NHOs historically were required to document the economic status of their board members each time they applied for a new 8A entity. And that was recently changed to say that if you can document that the underlying Native Hawaiian population or the population that you're going to serve is economically disadvantaged, then your board does not have to be economically disadvantaged, and you don't have to reestablish that fact every time you apply for a new 8A entity. And that was just a recent change in the regulations around NHOs in the 8A program.
Jammed.
So we can go to continuing eligibility.
Yes.
We'll talk about that a little bit.
And I want to say that I think this is important, and I know we have some large businesses who are also on the call, but in a bit we'll be talking about the new Mentor-Protégé program, and even under the existing 8A Mentor-Protégé program, you're making a decision as to whether or not you should consider someone as your protege. And these eligibility issues are important for you. You should be vetting these companies, especially under the new rules where you are limited to having 3 proteges at a time. And in fact, if you are a protege, you're limited to 2 mentors over the life of your company. So it becomes more important to make sure that that's the right relationship for the parties. So let's look at continued eligibility for 8A. I wonder why this is here.
Uh-oh, I don't
Hold on a second, guys. Okay.
Oh, what did I do? Sorry, guys. Is that where you were? Yep.
Okay. So couple of things, and again, remember, this is the business development program, so it's more highly regulated than the other programs. SBA wants you to let them know of any changes in your company. If you have a change of ownership, you need to get that approved prior to making the change, and there are certain packages that need to go into SBA. SBA is going to want to see what that change would look like. They're going to ask your potential investor for his or her financial information. So you want to make sure that you know what those rules and regulations are, because if you mess up, you could be terminated from the 8A program. Your annual submissions are important. You need to do them. It's a basis for termination if you don't submit. Make sure that you're compliant with your business mix requirements if they're applicable to you in the transition period. Again, if you're a potential mentor and you think you're going to be interested in doing work with that 8A under an 8A contract, make sure that there's not a business mix problem.
Yeah, and one thing that I'll say about annual reviews is that during my time at the SBA, one of the things that we were trying to focus on is allowing more time for business development rather than compliance, right? And so it is absolutely true that there's the Small Business Act requires an annual review for 100% of the portfolio. But it's not clear that that annual review should be the same for a firm is nascent, is new to the program, and is doing 0 contracts, as opposed to a firm that's in year 5 and is doing $10 to $20 million worth of contracts. So I know that while Jackie Robinson was running the 8A program, and I'm hoping that this continues, there was a significant initiative to reduce the burden on the nascent firms with respect to their compliance, especially if they're not receiving contracts. Because what we used to see is that a lot of firms would drop out in year 1 and 2, or even year 3, because the paperwork to do your annual review was so significant, and they weren't yet receiving any benefits. They didn't see the reason to do the paperwork. So rather than do all the paperwork, they would drop out. So I'm hoping that the SBA will continue in that direction, that the burdens on especially the nascent firms will be reduced. That's not to say, as Pam said, that you shouldn't make sure that you remain compliant with the program requirements, but that's to say that there should be more significance attached to business development as opposed to just the compliance, especially for the more nascent firms. Do we want to talk about this, because I know we have limited time and we want to get to other stuff?
Just to say that you will have to submit your personal financial information updated annually, your annual tax returns for the company, payment to each owner, officer, director, and that'll go along with some checklists as to ongoing economic disadvantage and whether or not the firm has engaged in excessive withdrawals. And then the SBA requires a listing of any fees paid to agents or representatives for assistance in obtaining or attempting to obtain federal contracts. So, if you're using consultants for that purpose, you could be raising a red flag, and you probably want to talk to somebody about those types of consulting agreements before you execute them.
Oh, hold on just a second. Let me try to switch back over here. Okay, now you can do it. We talked about that.
All right, we talked about this slide. Yeah. Excessive withdrawals, just know, please, that there is a provision in the regulations where, and it's a bit complicated, but it says that if a company has achieved more than $2 million in revenues, that a withdrawal from the firm is considered excessive as if it exceeds $400,000. And what is a withdrawal? It's a cash dividend outside of distributions to pay taxes if you're a subchapter S or an LLC, cash and property withdrawals, payments to immediate family members not employed by the participant. So you don't want to put family members on the payroll and be paying them if they're actually not working. Bonuses to officers. So salaries don't count toward that $400,000 number, but if you have a very low salary and if you have a very high salary and no bonus, SBA sort of reserves the right to take a look at it. The purpose of this rule is so that you're not just taking all of the money out of the company, that you're building an ongoing viable business. And this rule isn't supposed to be black and white, so you'll have an opportunity if you have had to take more than $400,000 off to justify that. But if SBA thinks that that was not a proper thing to do, it could result, I'm having trouble.
Oh, sorry.
It could result in program termination or early graduation, or we've seen situations where someone has inadvertently taken more than the $400,000 out, and when SBA's called it to their attention, the CEO was able to put the money back in the firm without any kind of retribution.
So real quick, I think there's some questions coming up with respect to the differences between tribally owned and individual tribe member owned, right? And the size of ANCs, et cetera. So there is a difference if, as a tribe, you can own multiple 8As, or as an NHO or as an ANC, you can own multiple 8As. However, a tribal member can also own an individual 8A. So there's a distinction between that. And then there's the question of an ANC, as an example, being a multi-billion-dollar corporation and yet owning 8A companies. And that's absolutely correct. The individual owned entity, the 8A, has to be small and is in the program for 9 years, but they are exempt, and I know I'm throwing a word out there that some people may or may not be familiar with, but they are exempt from affiliation with respect to being found other than small by being connected either to the parent company, the ANC, or any of the other wholly owned entities. So a lot of times, when I was at the SBA or I had to go to hearings, the question was, how can a multi-billion-dollar ANC get set-aside contracts? Well, the fact of the matter is that statute was written in a way that allowed for tribes, ANCs, NHOs to participate in the program to benefit the underlying communities. So there are some exemptions with respect to size, to affiliation, et cetera, because the intent of the program is that the benefits would flow to the recipient communities, which are very deserving of economic development. So again, it's really an economic development tool for those communities. I think one of the other questions had to do with the mentor-protégé program, and we'll talk about that in a little bit with respect to the differences in the 8A mentor-protégé program and the all-small mentor-protégé program. But one thing, I saw another question earlier on, the competitive landscape is certainly changing because in the set-aside categories and competitions, you are going to start facing, rather than individual firms, potentially joint ventures. So you may tomorrow be competing with a joint venture as opposed to just an individual firm. So you really have to think about strategy and your pipeline on how you're going to pursue opportunities, either in the 8A program or the all-small mentor-protégé program, because you can strategize to create a joint venture to pursue opportunities that are larger and more complex than you might otherwise have entertained.
And we're getting lots of questions on the excessive withdrawal rule. So just to clarify a couple of things, the excessive withdrawals do not include salaries of the owner. and they do not include distributions to pay taxes. Then the question came whether this excessive withdrawal rule applies to tribal 8A companies, and there is not an exclusion written in the SBA regulations. We had a case where a tribal 8A was not 100% owned by the tribe, but was owned by a tribe and its managers. And in that case, the excessive withdrawal rule did come up, and in fact it came up with respect to the tribe as well as to the non-tribal owners. We were able to show that there weren't excessive withdrawals, but the issue was raised, so I think it's a potential issue.
And the last slide in this section deals with change of ownership, and Pam alluded to this when we started the continuing eligibility discussion. We certainly see, obviously there's going to be, I think the SBA is going to look to see that the person that the designation is based upon has ownership and control. And so if that's going to change, it's going to have an impact on continuing eligibility. We do see, however, change in ownership in the sense of acquisition of firms that are leaving the 8A program by firms that have recently entered the 8A program. You want to make sure, certainly that does happen. There is a process for that to happen. There is a requirement that the transfer of contracts from the graduating firm to the new firm has to be approved, not only in its novation, not only with the agency where the contract exists, but within the SBA, and approval needs to be made, and it starts with the district office. But it does run through headquarters and get ultimate approval from the administrator. But any of those types of transactions require SBA approval and need to be strategized, planned, and executed very carefully.
That's right.
Okay. Should we go to the next section?
Yeah. Also, keep in mind with the change of ownership, John, this might be important, that they're going to want to see, as I said, the financial information, but the other thing that they're going to look at is whether or not that change of ownership in the 8A company is creating an affiliation with another business for size purposes. So if you're bringing in, let's say, a CEO of a second company, and you're bringing him in at a decent level for ownership in your company, there's a possibility that those two companies would then be deemed as affiliates of each other. So you really want to check before you do a change of ownership request, because it's a lot of work, and if it's going to trip you up, you certainly don't want to do it.
Yeah, I think the last slide in this section we might want to talk about. Oh.
That one?
No, staying small. So SBA can early graduate, I guess is the term, if you grow out of your primary NAICS code. You can say and make an argument and make a case for a secondary NAICS code, but you can't pick something out of the blue and say, oh yeah, I'm going to be small in shipbuilding starting tomorrow, right? And that's 1,500 employees, and therefore I can remain and continue to be small. There has to be in your business plan some reasonable argument that you are transitioning or growing into this other sector, and it should be specified with objectives, etc., in order to be able to remain small in the program. Did I get that correct?
You absolutely did. Absolutely did.
Right.
And sometimes the advice that we give is even at the outset, when you do your business plan, you try to envision, where will I be 2 years from now, 4 years from now, 5 years from now, and manage that plan so that you have already started to create a path for SBA, so that they can see that, yes, maybe you started out as a management consulting company which had a smaller size standard, but that you ultimately wanted to grow to be an IT company or a telecommunications company, so that you're setting that path so that when you do exceed that $7 million size standard, or that may not be the right number, but when you exceed that smaller NAICS code, that you have set forth a path that SBA is going to say, you're not there yet, we don't need to graduate you.
And the tribally owned or NHO ANCs are restricted to the same size standards. The individual entity is restricted to the same size standards, if I'm not mistaken.
That's right.
So they may graduate early as well. The only exemption is that they won't be found affiliated to their parent company or to the other companies in the
To their sister
umbrella.
company,
Right.
yes.
Right. Should we move on to the mentor-protege? So I think the next sort of section, and we can look through here and see if there was anything we want to answer before we go to the next section. But I think we're going to talk about the mentor-protege program as it has expanded to all smalls, and how you can benefit in participating in that program and sort of the changes with respect to all small mentor-protege, but also how that impacts the 8A world. I was at the SBA during the time that we got the rule, finalized, went out for public comment, launched the program. Holly Schick is running the program and is doing an excellent job implementing the program. It is an online process. Turnaround has been relatively quick. And 8As are also even applying it through the online process. And all the designations that the protege has flow to the mentor-protege agreement and to any subsequent joint ventures. What I will say, though, is that it is, and I was surprised, that there wasn't at the time when these rules were being considered, there wasn't a lot of objections or concerns raised from the 8A community, because I really, in my mind, anticipated more concern raised by the 8A community. And the reason is that the joint venture process or the mentor-protege process had been very successful in the 8A program. And it was something, it didn't come out through statute, it didn't come out by any direction from the Hill. The SBA created the program because it was thought that a protege could benefit significantly from being mentored by a larger firm. It doesn't mean large or huge, but by a larger firm that could bring some benefits to that protege. And there's always has to be a flow of benefits, right? It's not, hey, let's go out and get contracts. It's what is the protege lacking? Is it accounting systems, project management experience, project management systems, past performance, financial capability, bonding capacity, relationships with particular agencies or buyers. There has to be something that's missing, and the mentor-protege agreement really has to outline how those benefits are going to flow from the mentor to the protege. But given that, and you have to show that before the SBA approves it, given that there's the opportunity as one of the tools for development to do a joint venture and go after set-aside contracts. So, this creates, and because the Hill really liked and saw success in the 8A program, in 2010 in the Small Business Jobs Act, they said you have to expand this to all, actually originally to the other socio categories, and then eventually to all small. But, this creates more competition for 8A companies in the sense that the big mentors now can be looking at different proteges to participate in different set-aside opportunities. So it just creates more competition, I think, but it can be positive in the sense that because requirements are getting larger and more complex, oftentimes the individual small business isn't able to do 50% of the requirement. So this creates an environment where you can team up with a mentor, go after more complex consolidated requirements. And the benefit to the mentor is they can get up to 60% of that opportunity, that set-aside opportunity, where before, as a large firm, they couldn't have any of that opportunity. Now, again, it's up to 60%. That's something that can be negotiated. It doesn't mean your mentor has to take 60% of the work, but it is a benefit to the mentor as well in participating in this program.
So I think this is a major, major change, and it is exciting for the other programs, including for all small businesses, to be able to have a mentor who can make an investment of up to 40% equity in the protege, and probably more significantly, I think, can participate and set aside contracts as a joint venture partner. I also think this is a good tool for 8A companies or 8A graduates, because if we go back to the pie chart, you see that there are lots of different set-asides now that didn't exist probably a long time ago, but I remember. So now you might think about having additional opportunities to joint venture, and you don't have to be a mentor unless you're large. But if you are large, you can mentor a HUBZone company, a WOSB, any other small business, even though you may be a protege. You just have to show that you're a protege with needs in one industry, but you're capable of being a mentor in a different industry. So there are opportunities on both sides, I think, with this new all small program.
Yeah, I think the one thing that I would point out, and I see some questions coming up on the screen, is that you do have to, as a protege, you have to be, it's a little bit challenging because mentors now have a lot more options because it's the all small program. And the regs say you can have one, but up to three, but they can't be competitors. And then proteges can only have two mentors in their lifetime. So you want to be really picky as a protege with who you're going to go with, right? And what we tell our clients is that you really want to do a gap analysis to see what is it that I need from a mentor. And then your mentor-protege agreement really has to outline you getting those benefits over a period of time. SBA is going to ask that that gets laid out in the mentor-protege agreement, but, you know, my personal recommendation is that it needs to be as specific as possible for the protege. You know, what am I going to get? When am I going to get it? If there's an individual that's supposed to be providing me this assistance, who is it? And so forth, because you do only get two, and you want to make sure you get your you get what you need out of that. The intent is that you develop in such a way that after this mentor-protege relationship, you filled those gaps and can pursue opportunities on your own.
Mm-hmm. We should probably say that if you were in the 8A program and had a previous mentor or two or three, that doesn't count. So as of the effective date of this rule, which is August 24th, 2016, you get a fresh start. And so any previous that's already ended mentor-protege relationships don't count toward your two. However, if you are on August 24th, if you had a mentor, then that counts as one.
Yeah, so there's two questions here, and time flies, and we only have 12 minutes, but we can go a little bit longer. I know we might lose some folks, but we can go a little bit longer. There's a couple of questions. One is Department of Defense has an entirely different and separate program statutorily, and they actually pay the mentors to provide assistance to the protege. So that is entirely different than what the SBA offers. But the SBA's program, the mentor-protege program, can be used across the federal government. So the JVs that you do under that, you can bid on opportunities across the federal government. The other question is that the mentor-protege agreement under the all-small is good for 3 years, and it can be extended for an additional 3 years. Once that protection disappears, those JVs, if they continue, are at risk of being found affiliated or not.
So I say that it depends. Those joint ventures and the contracts awarded to those joint ventures or proposals that were pending at the time that that mentor-protege relationship was in existence and effective are protected. Okay. But you can't then use that joint venture to bid on something new. After that mentor-protege agreement is terminated. You cannot utilize any joint ventures because you don't have the exemption from affiliation. And if combined you're small, I mean you're large, or if your mentor is large, then you're done. And the other thing to be cautious of is continued assistance moving forward after expiration of that agreement could result in a finding of affiliation.
I have another question for you, Pam.
Well,
how about the 40% ownership?
Same thing. Good question. The mentor can make an investment of up to 40% in your company. You want to think about that. Sometimes there are good reasons to have that cash infusion. Sometimes it doesn't make any sense. But what we like to do is structure that change of ownership, if we're moving forward with it, in order to minimize the likelihood that after mentor-protege that change of ownership will result in affiliation between the former mentor and the protege, because it could. And oftentimes what we put into operating agreements or shareholder agreements is some sort of a buyout provision, so that if the protege still wants to be small, size still matters, and they don't feel that they will be small with that relationship, that there are exit provisions.
Yeah, and real quick, you want to be really careful. You know, I don't think we recommend the ownership equity stake unless it's a benefit to the protege, right? Because you want to be really careful, eyes wide open with respect to what's the exit strategy. Who has a right of first refusal? How is that going to work when you want to disengage from each other? And so that has to be really laid out well going in. The other questions that came up is, yes, you can have multiple joint ventures under a mentor-protege agreement. So you can have JV1, JV2, and JV3. And then the other is the 3-2 rule, which I think I got this right in Huntsville, by the way. Tell me if I get this right. So, okay, ready for this?
I think you might have written it.
I think John Klein read it. So I might have signed it. The 3-2 rule is that over 2 years, that JV can get up to 3 contracts. So you have 2 years or 3 contracts, depending on whatever comes first. But your clock doesn't start, so you can start bidding and bidding and bidding. You might not win anything. Your clock doesn't start until the first contract. Once you get that first contract, then you have either 2 years or 3 contract wins. Now, you might have 3 contract wins, or you might have the 2 years come up, and you have a lot of bids still outstanding. That doesn't mean that those will be rejected. It just means that you can't now bid on any new opportunities. Did I get that right?
That is exactly right.
Awesome.
Exactly right. So the 3 and 2 rule, that's your window of opportunity to bid, because obviously eligibility is determined at the time you submit your proposal. So when you submit your proposal, if you are within your 2-year window and you have not yet received contract number 3, you're fine. Then if you win, you get to keep it.
The last thing I'll say on mentor-protege is that for mentors, right, you want to make sure that your protege is indeed who they say they are, right? Yeah. So you want to make sure if they're 8A certified, are they in DSPS, are there issues with continuing eligibility, all those types of things. HUBZone, similar. The self-representation programs, even small. You're self-representing is small, right? You don't want to go through the mentor-protege agreement approval, pursuing JVs, JV, and then finding out that through a protest you don't get the contract that you had targeted. And then the last thing I'll say is that joint ventures in the 8A program still have to be approved at the district office. Joint ventures under the all small don't have to be approved but are subject to protests. So you want to make sure you write the joint venture and an agreement, an operating agreement, in such a way that it will be protest proof. You don't want to win an opportunity, go to protest and find out that the mentor has undue influence on the protege and the JV. The JV, the protege needs to have the project or program manager, and they need to have control. And if you're seeing, or the SBA sees an undue influence by the mentor in such a way that the protege can't buy, I don't know, I'm looking at tissue paper, without getting the approval of the mentor, don't ask me why I'm looking at tissue paper, doesn't get approval of the mentor for buying office products, that's a problem, right? So you want to make sure it's protest proof. What lies ahead? We have 4 minutes for what lies ahead. You want to sort of brush over the next
Yeah, I think we
slides?
talked about this first page in that, you know, there are opportunities under the All Small program for all small businesses and possibly even for 8A companies who may want to be a mentor to someone who's in another program or a graduate. And by the way, if an 8A graduate hasn't had a second protege or even any proteges when it graduates from the 8A program, that company, you can participate in the all small program. So you just have to meet the eligibility criteria, and the fact that you've graduated from the 8A program is not going to harm you.
Yeah, and the one thing that I'll say here is that you want to make sure, I was trying to say, the competitive landscape is changing, right? So I think this slide is important to the fact that you want to make sure you find your opportunities that you're going to bid on and find partners to bid on that.
Right.
Because you might be not be competing with another small, you're going to be competing with a JV.
And also, I want to mention similarly situated because, again, the competitive landscape is changing. And several years ago, Congress made the similarly situated rule into a law. SBA has drafted a regulation on this. You need to know that there's no FAR change yet. So while this is an implemented SBA regulation, if you think it would be relevant to have in an RFP, you may have to go to the contracting officer and ask them to get a deviation from the FAR clause to implement the SBA regulation. But the similarly situated rule says that two companies that are similarly situated can team together and can satisfy the performance of work or limitation on subcontracting requirement together. So if it's an 8A contract, two 8A company, and it's a service contract, two 8A companies can team together and they can satisfy the performance of work requirement, which would be a 50% limitation on subcontracting under a service contract. HUBZone companies and SDVOSBs already had that benefit, but now this applies to all smalls, 8As, and WOSBs as well. To remember, it has to be similarly situated, so identical socioeconomic class and small. But small is dictated by the NAICS code on the work that's being performed. So you may be performing work under one NAICS code, and your teaming partner who's similarly situated could be performing work under another NAICS code under which it's small, and that qualifies. So that's just a little tidbit because it's not necessarily clear in the regulations, but you as the prime contractor get to select the NAICS code that best describes the work that your subcontractor is performing.
So there's two things. One is on page 39, there is a little typo that got pointed out. The two bullets are the same. There's no intent. There's not overemphasis on those two first bullet points.
Sorry.
But the other question that came up is what's the difference between the all small and the 8A mentor-protege programs? Again, the designation of the protege flows to that mentor-protege agreement. You can still, my understanding is, and SBA can clarify, that you can still go through the district office for your mentor-protege agreement under the 8A program, or you can apply online through certify.sba.gov, and the designation of the protege will follow that mentor-protege agreement. Whatever it is, 8A, HUBZone, STVO, etc. The only difference is that your joint ventures for the 8A mentor-protege agreement do have to be approved by the district office.
Your mentor-protege, your joint ventures for 8A contracts have to be approved. Yep.
Question keeps coming up with respect to where the PowerPoints are. The PowerPoints are on our website. They should be there, and it should be under the tab that you have in front of you, also handouts. In this application, I don't see
somewhere
it.
right there, handouts.
Yeah, 105. So you should have it. If you don't, feel free to email us. We'll make sure that you get a copy. If you want to be on our mailing list, email us, and we'll make sure that you're on the mailing list. There's a weekly update that goes out to folks, right? That they can get on the
Absolutely.
list.
Absolutely. And I think we tried to answer a lot of the questions, but we have a bunch. So if we didn't get to them, we will send you an email. And if we don't understand it or if we think it's complicated, we might give you a call to talk it through.
Oh, I have one question that before we go, any update on Rothy? What I did want to mention this, and so, you know, I spent the last 7 years at the SBA, and there were challenges during that time to the 8A program, right, on the constitutionality of the program. Be it Rothy, you know, we had Rothy 1 and 2, we had Dynalantic, et cetera. We spent a good portion of that time protecting the program, and we had a lot of assistance from the Department of Commerce to do the study and analysis with respect to the underserved communities and their participation not only in government contracting but in industry. And then we had a lot of support from the Department of Justice in protecting the program. You know, with the change in administration, it's unknown what the stature of the administration will be with respect to protecting the program. What I would say and what I would suggest is for those of you who are in the program, who are interested in the program and would like to advocate for the program, is make sure that you are preemptive as opposed to reactionary with respect to advocating for the program. It's a very important program. It serves a very required need not only in the individual communities, the 8A communities, but also in the communities, tribal, Native Hawaiian, Alaskan Native, et cetera. These benefits flow to the intended recipients. It's done a lot of good work over the years, and we want to make sure that it continues. Anything else on that?
Well, just the other point that John and I were talking about the other day is that there are a lot of new Hill staffers.
Yeah.
And committee Hill staffers, House and Senate Small Business. And so to the extent that you have, you know, time or that your congressperson is active on one of those committees, or even if they're not, the more we can do to increase the awareness of the program, the more Congress can do to make sure that it meets the constitutional standard required for the court to say, yes, this is constitutional, it's compelling government interest, and it's narrowly defined. So, you know, we can't sit back and watch and wait. If this is important, we need to put together some sort of concerted educational effort, I think.
Yeah, and the last thing I'll say is, you know, with respect to sort of the administration changes, et cetera, historically, and granted, this isn't, and I don't want to get political, but I don't think this is political. This is not necessarily a traditional Republican administration, but historically, Republican administrations have de-emphasized the 8A program and emphasized HUBZone and SDVO. But I don't, again,
WSP.
Yeah, but I don't know if that will happen in this instance. We have seen, because of the cap on FTEs, and then that got removed, but there was still a lot of language around budgets and maintaining budgets, et cetera. We've seen outsourcing of activities, which has increased opportunities for our firms. Obviously, we keep hearing about a buildup at the Department of Defense, so that should increase opportunities for those that are selling to the Department of Defense. Some of the civilian agencies have been you know, threatened to be cut. But the one thing that I would point to is that, you know, the presidents went through this for 7 years. The president's budgets are sort of wish lists. Congress appropriates, and they will go through that wish list and make adjustments as they see fit. And so this, again, becomes important with the small business contracting community, making sure that their voice is heard with their representatives or with the small business committees, et cetera. Anything else we want to add before we leave?
Well, the last slide is a little bit of what we're seeing, but this is sort of crystal balling, and we don't know how things are going to shake out. But this is a trend that we saw even in the last administration, and I don't know that we see anything that suggests that it won't continue. At least the emphasis on commercial items, that's that's ongoing. This administration's talking about Buy American. The last Congress did, under the National Defense Authorization Act, that was pre-Trump, but said that there should be no more low-price, technically acceptable procurements for the DoD for technical and professional service contracts. So we've been seeing so much of that, and it seems like that pendulum swung way over to LPTA, and I think that the contracting community is hoping it's going to swing back a little bit to be able to have more reasonableness in terms of award prices.
Yeah, and before we go, and I know we're going over, we could talk all afternoon. There was a question early on with respect to joint ventures and quals, past performance, for the joint venture members. I think there was statute or reg changes that required that the agency consider the qualifications of the members of the joint venture as the joint venture's past performance. And that is a requirement. If you're seeing solicitations that are saying the JV has to itself have quals, those could be, you know, not to try to increase business for the law firm, but could that not be a protest, a bid protest in
if they don't allow the quals of the members of the joint venture? That would be a defect in the solicitation, and if we couldn't get that fixed during discussion questions, then we would have to protest that prior to the due date for proposals, but it would be protestable. So,
and I think that's really important, because oftentimes the JV itself is not going to, unless it's in the third contract, it's not going to have quals, past performance. So I think that was and you know, we used to get this at the SBA as well. That is a flaw to require the JV itself to have past performance qualifications.
Let me answer a couple more things. If you're interested in more information on the similarly situated rule, you can go to our website, because we did a webinar on the whole limitations on subcontracting, and that similarly situated rule is a part of that. So, and if you can't find it, just send us an email and we can refer you to the right place, and we can also probably send you separately a more robust PowerPoint presentation on that rule itself.
Do we have there's a website.
Our website's on the last page. It's just poleromaza.com. And again, if you want to sign up for our newsletters, please get on there and sign up or send us an email. I don't think we hit all of the answers to questions, so we will be getting back to you on that. And thank you all so much for participating. I hope you thought it was useful, and thank you for your time.
Thank you all. Have a good afternoon.